Hi everyone, welcome back to my channel. Today's topic is about helping beginners start investing. Okay, so I'll be sharing about 3 simple ways to start your investing journey. Okay, so let's go. Okay, so before I start this, let me just say that this is just for educational purpose and not financial advice. Okay, so it's 3 simple ways to start investing in Singapore, and this is available to everyone. So if you try to go into mutual funds, then you have a minimum asset under management to meet, that kind of thing. That's not for you. We are all layman investors, so it's available to everyone, beginners. Okay. So before I start, let me share the agenda as well. So I will first define what is investing, and then why should you invest as early as you can. Okay, and also some questions for you to think about and ask yourself before you start investing. Okay, then I will share about the 3 simple ways to invest. Okay, so moving on to the definition of investing. Okay, this is bear in mind, this is just my own definition. So to me, if they don't meet all these conditions, then they are trading to me. It's not considered investing. Okay. So investing for me is always for retirement goals lah. And then you only have the time between now until you reach your retirement age. Most people will cap it at 65, so it's up to you to determine your own retirement age. Okay, so long term is must be long term investment. Okay, holding for a minimum about 15 to 20 years, I suppose. Okay, then for investments, to me, it should be diversified. So anything that is not diversified has a concentrated risk that could fail even in the long term. So let's say you invest in a stock like Nokia, one day it go bust, and then your investment is gone. So your retirement plan, poof. Yeah, so that's why diversification is very important. Okay, consistency is also very important. So once you start investing, you need to be able to add to it at certain intervals, because your initial investment amount is highly unlikely to be sufficient lah. Yeah. Okay, so why should you invest as early as you can? Okay, let's share one quote first. The best time to start investing was yesterday. The second best time is now. Okay, so it depends whether you're a bear or bull market lah. This is a quote. Okay, so why should you invest as early as you can is to beat inflation or at least maintain your real purchasing power. Okay, also take advantage of time value of money and compounding interest. You can also save more money when you start early, because you definitely know better financial knowledge, right? You will start saving more money because you can contribute more to your investment plans lah. Okay, then more time for you to recover from losses, if any, because market is not forever up ma. Also sometimes down up ma. And then in the long term, it definitely goes up lah. So yeah. Okay, so and then if you start as early as you can, you also have a better risk-taking ability. So let's say you start at 20 years old versus you start at 30 years old. So let's say 30 years old, you have family, all these other commitments, then you have less risk-taking ability lah. So as you are younger, you have a more risk appetite. Like if you're a kid, you lose your $10 pocket money, it's like nothing much to you, right? Okay, so better risk-taking ability. And also you are if you start investing early, you have the option to retire early if your investment grows exceptionally well. Okay, so here's an example of why you should invest as early as you can. So one example is me starting now versus me starting 10 years ago. Okay, so imagine if I started investing 10 years ago, $1,000 a month, right? So $1,000 a month, I would have invested 12k a year. So 12k a year, if I didn't invest 10 years ago, so maybe I have 120k in savings. So what I have now, lump sum, I want to put into an investment. So it's 120k. Okay, versus my I commit to myself that I will put in $1,000 every month for my investment. Okay, so I will consistently invest per month. So this is my payments. Okay, so in case you didn't know what is this, right? It's a financial calculator lah. Basically, you punch in all the numbers, they will tell you at the end of how many years, based on the rate of return and the compounding and everything, what's your future value. Okay, so assuming my investment grows at an annual rate of 8%, okay, and then the periods I will use as my compounding as monthly lah. So compounding monthly will be 420 periods. So assuming now I'm 30 years old, which I actually am not, but never mind, assuming. Okay, 35 years times 12 months, so I only have 420 months to go before I reach my retirement at 65 years old lah. Okay, so assuming I put all this into the financial calculator, and then I start investing with 120k lump sum and $1,000 monthly, then the future value of what I will get is about 4.2 million. Okay, so if I had started 10 years earlier, so if I started 10 years earlier, back then the savings was zero lah, then I start investing 1,000 a month for 45 years. So this one is 35 for 45, right? 45 times 12, 540. You punch in all the same numbers except the present value and the payments. Okay, so the future value you can see is 5.2 million. So you actually save 1 million more by starting 10 years earlier. Okay, yeah, so it's the same amount of money, but then you start 10 years earlier, you get 1 million more. Okay, at retirement lah. Okay. Okay, another example. So why you should consistently invest instead of maybe do a lump sum every year, because consistently investing also give you the advantage of dollar cost averaging, avoiding all the what's that called, timing, bad timings that you go in at lah. Okay, so let's say you choose to invest at the end of the year. Every time you will put in 12k lah, so you invest annually and compound annually. Okay, so with the same, just now you compare with this one, right? You compare the same amount, it's actually the same lah. So 35 years, compound annually, so the periods become 35. Annual rate is the same, and the future value is actually 400k less than here. If I actually did the dollar cost average $1,000 into the investments lah. So that's why you should always spread out your investments. Don't go like lump sum. I mean, now if you have a lump sum and you really want to go in, then go in lah. But best is you just go into small amounts, unless you know you have a very good timing and now the stock market is all time low and you can go in, then yeah, by all means go in with a lump sum lah. Okay, but that one subject to timing risk lah. Okay. Okay, so some questions to ask yourself before you invest. What sector do you believe in? Is it tech or whatever? So invest in something you think will definitely be needed in the future. Okay, so how much are you able to commit per month? And then commit now and also monthly. So if you want to do lump sum, you can commit now also, and then monthly. And then are you disciplined enough? You ask yourself honestly lah, are you disciplined enough to do it yourself? Like every month you're going to go in and throw the money in. Are you going to do it? You're not going to do it, then need to think about yourself lah, whether you really see the market go up, go down, you can go in or not. Okay, so how much time can you actually commit to doing this? And then what is your risk and volatility tolerance? Okay, then lastly is do I actually have the knowledge to actively invest? Okay, so 3 things other than investing you should consider before you start investing. Have you paid off any high interest debt? So any high interest debt should be settled before you start investing. Okay, do you already purchase enough insurance coverage? Okay, so all these are recommended by CD, not me. Okay, have you already set aside a rainy day fund? So your investing portfolio should be part of your whole financial portfolio. It should not be comprising of your whole financial portfolio. Okay, yeah. Okay, so moving on to the 3 simple ways to invest. So depending on your answers to the questions in those previous slides that you have to ask yourself, right? Then you will use different simple ways lah. Okay, so if you have least knowledge, then you have to use this one lah. Okay, so least knowledge, you don't know shit, and then you want people to guide them throughout the process, and then you are not disciplined enough. So you need a system in place to help you put it in, because you are not disciplined enough. You see the market up, down, you don't dare put in. Okay, so this plan, investment linked plans, will help you with that. Okay, so how it helps is automated deduction of funds monthly using a credit card or gyro, and then by right, your advisor is supposed to help you monitor your investments and then advise you accordingly. So let's say you are not good, I mean your risk tolerance is low, then maybe go for a lower risk fund, that kind of thing lah. Okay, then next, if you know a bit of shit, then you can go for robo advisors. Okay, so for this, technically you specify your risk tolerance, and then they will help you choose the funds to invest into lah. So you do not need a physical person to babysit you. And then for this, you also can do automated deductions of funds via direct debit. Okay, so this one, there's no human helping you watching all these investments. So you still need to go in and monitor yourself whether the portfolio is performing up to your standards. So you do need some knowledge. Okay, whereas investment linked plans is basically you trust your advisor and everything just throw to them. Okay, then lastly, we come to the least knowledge. The most knowledge that you need one, low cost broker, you go and invest yourself. Okay, then as you can see here, also increasing management costs and fees depending on which one you choose. So this one is the costliest because you need a human to help you. Whereas if you use a low cost broker, totally no human helping you, Okay, so for people who are more investment savvy, know what they want, able to exercise discipline to do consistent investing. So like you know how to time your own investments lah. Okay, so for this kind of low cost brokers, right, there's no auto debiting, so means like you have to constantly deposit fresh funds inside and then you time when you want to go into the investments. Okay, so you need to enter into the investments yourself every month. Okay, monitor your own investment, choose your own funds. Okay, so just going, like if you talk about insurance, of course we want our retirement funds to be safe, right? So for these 3 simple ways, what happens if all these actually go bust, like the insurer go bust or the robo-advisor go bust? Okay, so I went to research about it also. Yeah, so I'm also sharing this because of the recent crypto collapse. So everyone wants to know whether your funds are protected. So other than protecting your funds, also need to protect your own self, your own life, everything. So insurance very important. So for investment linked plans, actually technically there's no protection at all if the insurer goes bust, but I think in Singapore there's no history of any insurer going bust, so yeah. So if you didn't know, it's not protected under this policy owners protection scheme. So all your insurance actually protect under this scheme. There's a limit per insurer that they protect also, but these investment linked plans are considered investments, so they are not insured under this protection owners scheme lah. Okay, so the insurer's credit risk is very important. So if you know the insurer is a very cui one, then maybe you want to avoid doing investments with them lah. Okay, then robo-advisors. Okay, so robo-advisors is very similar to investment brokers, whereby their funds are held in a custodian account. So for custodian account, they have 2 types. One can be commingled or can be under your own name lah. Okay, so this custodian account is actually separate from the firm's accounts via 2 MAS license, depending on what license they have. If they have the capital markets license, it's held in a trust account of a brokerage firm, or if they have a licensed financial advisor license, then they have their own custodian account. Okay, so maybe when they go bust, the exit strategy is like they will force you to liquidate your assets at loss, or else you can switch to their partner fund manager and continue holding the assets lah. Yeah. Okay, so next, investment brokers, same, held in a custodian account if they have the MAS capital markets license lah. So most likely these 2 can get back your money, whereas insurer go bust, then you cannot get back your money lah. Yeah. Okay, so the 3 simple ways to invest. Why do I choose funds? Okay, so like I mentioned, it needs to be diversified, and then if you look at history, there are many times that history actually repeats itself multiple times lah. Okay, so if you are looking about investing, you can look at, I mean, I personally don't like the SG market, but you can still look at the SG market. Okay, so SG market has the Straits Times Index ETF. Okay, so it's the leading Singapore companies, and then their performance of this one I take from their annual report lah. So their fund, right, is actually performing at 6.29% annualized since inception. Okay, then if you are looking at the US market, so US market, the most oldest fund available is the S&P 500, which is the SPY. Okay, so you can see the oldest ETF in the world. Since inception, when did they incept? Okay, 1993, right? Is it 1993? Yeah, 1993. So since inception, it has been performing at a 9.59%. Yeah, so if you compare 3% a year difference, if you invest in the SG market versus the US market, it's going to make a huge lot of difference lah. Okay, so unless you really care about the what exchange rate difference, but it's not going to make up to about 3%, right? Okay, so some people are concerned about FX whatever thingy, but I don't know, it's up to you lah. So as you can see, the US market does present itself with more opportunities lah, because maybe innovation is not that great in Singapore or something. Okay, yeah. Okay, so zooming into 4C, so 4A and 4B, you don't need much guidance lah. 4B, you just open an account with the robo-advisor and start your investing lor. I mean, if you are Gen Z, you're a millennial, most likely it's very easy to do. And then using investment linked plans, definitely you have an advisor guiding you. Then 4C will be the low cost broker, which is the hardest to do, right? So maybe you need some guidance. Okay, so since you are investing on a monthly basis, you want low fees. So first you have to do how you're going to start invest. You need to research into what funds are suitable for your investing strategy. So you Google and search what is available, what kind of funds are available. Okay, look into their top holdings, okay, top holdings, and then see whether are they the ideal things that you want to invest inside, and look at their expense ratio. So if a fund has a too high expense ratio, then how is it going to be profitable, right? Okay, then okay, once you have decided the funds you want to invest in, then you look for a suitable low cost broker that you can invest in the market you want to invest. So let's say you're going for US market or Hong Kong market, you can go for Weibo. Okay, so Weibo is low or no platform fees for now. So I don't know whether next time they will have. Okay, low or no commission fees for now, and low or no margin fees for now. Okay, so if you go and compare with the other brokers, they are currently one of the lowest lah. Okay, then it's pretty easy to deposit and withdraw money. They use this gyro debit or gyro credit or something. Yeah, so easy to deposit and withdraw. I tried to deposit and withdraw before. I can put the link down to the video below. Okay, I've tried their support as well. So their support is usually 24/7, and then has a reliable support to assist if you need any questions to be answered. Okay, interface is pretty easy to use. It has dark mode or light mode. I mean, I prefer light mode. Yeah. Okay, so what's important is also is able to support fractional shares for dollar cost averaging. Okay, so for dollar cost averaging, right, you want to be able to put the same amount every month, so that it's not going to be like you buy less when the stock market is high, and then you buy more when the stock market is low, so you can earn like the difference, like that kind of thing. Okay, so for brokers that are able to support fractional shares, you can choose to use the same amount every month to dollar cost average. So let's say the SPY currently is at $400. Then for this month, then you buy the SPY $400, just nice you buy one share. But then next month, maybe the SPY go up to like $450. Okay, then you still want to invest $400, right? So you can buy when it's high, you buy lesser of it, so you can actually profit from that. Okay, so if your broker does not support fractional shares, you can't do the same amount every month. You need to buy one share of SPY. Okay, so it depends on your investing objective whether you want to buy this kind of fractional shares lah. Okay, so not all brokers support fractional shares. You need to check which broker support this. And also lastly, you need to learn how to time the market. I mean, if you really don't know how to time, then like just buy on red days lah. Yeah, buy every month, but only buy on red days. Okay, then if you are worried about like SPY going bust or whatever, I don't know, diversify into as many funds as you want, but do not buy individual stocks if you do not have sufficient knowledge. Okay, so like I mentioned, like back when Nokia was so popular, everyone never knew that Nokia could actually go like to where it is today. It's not that great. Okay, so yeah, so Apple, maybe one day they might not be so profitable anymore, and then possibly can even go bust. Nobody will know these kind of things. Okay, whereas if you're talking about like SPY, right, US S&P 500, these top 500 funds, right, I mean not funds, top 500 stocks are actually always changing every quarter, or I don't know how they review it, but when they review it, right, it will keep changing. So it's all the profitable ones that are always in this index. Okay, so that's why it's able to remain profitable. I mean, like sustain growth over the years lah. Okay, so you can log in every month to take a quick look whether there's a need to change your investing strategy for your new funds. But I would say stay committed to your previous investments lah, because you actually went into them for a reason, right? Like you done your due diligence and you went into them for a reason. Unless the reasoning is no longer valid, then you can switch them out of your existing funds lah. Yeah. Okay, that's all. It's really very simple, and you do not need to do any huge commitment amounts. Can start from $200 a month, that kind of thing. Yeah. Okay, so that's the end. Okay, so I hope you guys have learned something new today. If you have any questions, feel free to drop a comment down below. Depending on whether it's a sensitive topic, I will reply them. If it's sensitive, I won't reply them. If it's not sensitive, then I'll reply them. Okay, so yeah, that's all for today. Thank you everyone. Please help to like and subscribe. Bye.